we usually talk about things like profitability in trading. And if someone talks to me or I talk to someone asking about his profitability, over the time I became aware of the fact that many people don't really don't really know what profitability in trading really is. In fact, it's very simple. It's a formula I will present to you today, but it has nothing to do with making money in one trade or something. So this is something I can already say right now. We all know that losing is part of the game. And still, at the end of the day, even if you're facing a losing trade, that doesn't necessarily mean that you're unprofitable, but you can be highly profitable. But if you lost on one trade, well, it's just part of the game. Yeah, and this is exactly what we want to dig into then over the next 45 minutes around. And yeah, so let's start with today's agenda. Let's give a quick idea of what we are about to look at here. So first of all, there will be the introduction, the 3 columns of profitable trading. I will introduce them once again to you, and then today we will obviously focus on the risk and money management side, since these topics, expected value, payoff ratio, but also risk of ruin, they're all part of this column, risk and money management. So profitability in trading, the expected value, this is what we want to look at. We want to look at the payoff ratio. What's very interesting, in fact, is something, if you're right now visiting YouTube here, watching the recording on YouTube, on a YouTube channel from Admiral Markets. Hey, by the way, if you like what you're about to hear, please leave a thumb up there for us. If you have any questions arising over the next minutes, also drop them in the chat box below the video, also here in the chat box within this webinar. I'm more than happy to answer these questions. So yeah, if you watch this recording now, or right now listening to me here, probably you haven't heard about payoff ratio before. It's very interesting. In my career so far, I've worked also with with many international offices and also traders around the globe. And I remember one time we were in a call, and I was referring to payoff ratio. So it was among traders and market analysts back then. And I was referring to payoff ratio, and then it was a group of analysts and colleagues here I was talking to, and then someone just asked, Jens, just one thing, what is payoff ratio? And it was a U.S. American trader, in fact, who asked this question, and I was a little surprised because payoff ratio usually is, at least in my trading, a common what's the word for this? Common parameter, or yeah, whatever. So it's something which is very, very important, in fact, to trading, and we will see why in a few minutes then. What I found out is that payoff ratio, so we're talking here about the average gain divided by the average loser, is something which is usually referred to in the English-speaking world as profit factor, if I'm not mistaken. So it's very, very similar, very common, very, very similar, payoff ratio, profit factor. So just that you get an idea of what we're talking about here. So the next thing we will talk about is risk of ruin. In fact, you will see that all these components here play together in one or the other way. And probably you also get an idea of why it makes sense to let winning trades run and cut losing trades short. So it's usually the easy saying, quote, you will probably have read in several trading books you read through over the years. But what's interesting is that you just take it as granted, and then you think that this is the reason why profitable traders are profitable. They let winning trades run and cut losing trades short. But I have some doubts that everyone really gets why this is so important. And in fact, all these 3 components here, they perfectly show why you should let winning trades run and cut them short, even though it's difficult. We had this already in several other webinars before. One was on the emotional side, emotions and trading, and here behavioral finance. I introduced this concept to you of loss aversion, and which is the main reason why it's so difficult to let winning trades run and cut them them short. Still, it's in fact key to profitability in trading, and then we will see why this is here in this case for the column then of risk and money management. And at the end, I will also introduce something. It's called Monte Carlo simulations, but we'll run a separate webinar on this within this Trading Spotlight series. So over the month of October, I'm not really sure about the date right now, but I can already tell you that we will have a webinar on the topic of Monte Carlo simulations alone, since it's a very, very yeah, it's a strong topic. It can really improve your trading in several aspects, and we probably dig a little into this of how to use it in your trading already today then. So yeah, this is me. The only thing I'd like to say here is that I'm located in Berlin in Germany. And for any other questions, check out the box here below the YouTube video, or also the interview I've given to Admiral several months already ago, I think. And it was on my start in this business, how I get started in trading in general. And that's all, in fact, I want to say. But one thing I'd like to point it out, I'm located in Berlin in Germany. And why is this important? Because Admiral Markets also has an office here in Berlin in Germany. And yeah, it's very important to mention here, because all this this whole Trading Spotlight series is possible because Admiral Markets is investing a lot in educating its clients, but also non-clients, who will hopefully become rather sooner or later clients. Yeah, the reason for that is usually you have to have a certain business model to really want to educate your people. And the thing here, why I mentioned Berlin, Germany in this case, is it's not just that Admiral Markets has a very, very great business model in general, but also a highly competitive offering when it comes, for example, to DAX trading. So here in Germany, we refer to Admiral Markets usually as the so-called DAX expert, or yeah, DAX expert. I think this is a good way to put it. So because of this highly competitive offering Admiral is offering here, you can see it, typical spread for the DAX. It's not just typical, but it's during main trading hours, it's 0.8 points. And there's also an offering, it's called Admiral Prime. Check out the website for further information on that. So you can, and this is especially interesting for probably short-term traders, also get a 0.2 point spread in the DAX and then pay a commission on top of that. And that's very important to mention, especially for short-term traders, since these conditions make it really possible to profitably trade them in the long run, in fact. Offices around the globe, you can see, okay, I'm located in Germany, so obviously there's a German-speaking service then, but also English-speaking service. There's some offices in Chile, for example, in Australia, so around the globe. And so when talking about Admiral Markets, you really talk about the global player, and it's definitely worth it to give Admiral a deeper look. And so now we want to start with the 3 columns of profitable trading, and remember them once again. So this is the column. It's no coincidence that it's red. It's today's topic, risk and money management. The second column, trading psychology. We also had several webinars on this topic in the past. And then we have trading strategy with an edge. Also here, we had already a webinar. I'd also like to mention here our Trading Spotlight trading community on Traders Yard. So stay till the end, so you will have a chance then to see where we have our small community, let's call it. And they can ask all questions. We make trades a topic, for example, also based on strategies. I presented already here and other webinars on the DAX, on the S&P 500. And it's not only that I present trades based on that, but I think to get the real most out of all this here, trading strategies being presented in webinars, but you also need to see how to really trade them in the real world. And not only that, but also track these results and then try to make something out of it to finally become profitable in your trading. And this is what all these webinars here around this Trading Spotlight series is about, or respectively, also this Traders Yard community, in fact, is about. Yeah, and so risk and money management is today's topic. Profitability in trading is built on these 3 columns. Now, the interesting thing is, if you're an expert on, let's say, risk and money management, that doesn't necessarily mean that you get profitable in your trading, because all these columns here, they interact really strongly with each other. They seem to stand there independently from each other, but they strongly interact with each other. And I want to give you an idea of how they interact with each other, a quick overview. So here, I want to put out or take out risk money management and trading psychology. And it's in fact not very difficult. And so we will take a very simple example here, but everyone will see that the interaction here is obviously strongly given. So let's say, or not, let's just say, just imagine the following. If you trade a position, or if you open a position which is far too big in relation to your trading capital, so using a high leverage in your trading, this will naturally result in a behavior which will result in quick profit taking and letting losing trades run. So which means on the other hand, put it simply, just imagine you have a simple 9 to 5 job, and you're bringing home, let's say, 3,000 euros at the end of each month, just to give a number. And then imagine you're opening a trade which is far too big in relation to your position. And let's say it's necessary to have a given risk reward of 1 to 2 in this trade, which means you're risking, let's say, 1,000 euros while you aim for 2,000 euros. And now imagine the following. The market moves in your direction within this setup, and you're ahead 1,500 euros. And you're day trading, which means you make this money, these 1,500 euros you see in your P&L and your trading platform, you make them within, let's say, 10, 15 minutes, because it's a very strong breakout, which happens, for example, in the DAX on the upside, on the downside, doesn't matter. So now imagine the following. You have a job, a day-to-day job, which brings you 3,000 a month as a salary, or which generates this salary. And then you make 50% of that, 1,500 euros, within 10 minutes, let's say. Usually you go to work 40 hours a week, which means around 160, probably some 180 hours a month. And now you make 50% of that within 10 minutes. But you also know that to keep the profitability of this trading approach, you need to let the trade run another 500 euros, else profitability will be a big problem to achieve in the long run. Profitability, we will define this in a few minutes. So you take the trade and the profit in this case of 1,500 euros. On the other hand, imagine that the market moves against you, and you probably have a strategy, but still there will be some headaches once the market moves against you. And now imagine that the market moves, let's say, 1,000 euros against you. You bring home again those 3,000 a month. You know quick market conditions. Everyone probably faced them one or the other day. And so you're losing within 10, 15 minutes, 1/3 of the money you usually make within 1 month. And this within minutes, okay? So that this will naturally result in a behavior which motivates you to probably take out the trade, because you say, hey, I have the hope that the market will turn around, looks like stop fishing, whatever reason you will bring up. You need to stay with your stop you placed and not just move it. And so all this comes down to mental stability in your trading, and which obviously shows that risk money management and trading psychology affect each other, since an inadequate position size will naturally result in some behavior if you're not mentally stable in your trading, which is over the long run unprofitable, or to keep it with the definition we will introduce in a few minutes, you trade here then with a negative expected value, in fact. So that's how risk money management and trading psychology obviously interact with each other. Risk money management and trading strategy, profitable trading strategy, also interact with each other. So here the question arises, the question what's your edge in your trading? So usually when someone comes to me and asks, hey Jens, shall I start trading? There's several answers to this question. It's not only yes and no, but it depends on many aspects. And one is, for example, the question, do you have a business model or do you have a profitable trading strategy? So you know what you're doing. Some people just download the platform from their broker they want to trade with. They download the platform and then they just keep trading. What can be so difficult to buy low and sell high? Well, Obviously a lot, because there's several numbers you can find everywhere in the internet. I usually call it 90-90-90. It's 90% of the people lose 90% of their money within 90 days. So this is the rule of thumb. And the thing is, the reason for that is very simple, because they don't have a strategy. They don't have an edge. Now, the thing is, just imagine you have this edge. Okay, then you know about things like, for example, a payoff ratio. So average gain, average loser, you have the hit rate, you have run a very solid backtest, and you know about all these aspects. You know you're trading with a positive expected value. Okay, great. But still, at the end of the day, the question arises, and we had this topic last week, so you probably remember. If not, please feel free to watch the recording of last week's Trading Spotlight webinar in regard to the position size, the optimal position size. So we are not only sitting in front of the screen to make sure we don't lose money. At the end of the day, this is what trading is about. But still, for all the pain and for all those bad feelings we get when trading the markets, and everyone who has traded with a real money account knows what I'm talking about here. We want to get paid in an adequate way. We want to get an attractive payoff. We want to see an optimal growth of our equity curve, which means at the end of the day that based on your strategy and your edge you have, you then have to use your knowledge in regards to risk and money management to calculate your optimal position size to generate exactly that, an equity growth or an equity curve, which is on one hand rising, which means you're trading with a positive expectancy, and it has to make sure that potential drawdowns are kept small, while on the other hand, you want to see an optimal growth of the equity curve to get the most out of your pain you're facing when trading the markets. And so you can perfectly see how risk and money management and trading, profitable trading strategies then interact with each other. So I've now prepared the following here in regards to the expected value. I've talked about this now several times already, and in fact, it's not very difficult to understand, I think. I hope so, at least. But still, it's something which is crucial. It's essential to understand positive expectancy, or expected value in general, because it makes it possible for you to understand why certain steps you take in your trading may be good while others are not. So, and you can, by the way, if you grasp this concept around expected value, you can adopt this to several other concepts in your whole life, in your business life, everywhere. So everywhere we are faced with uncertainties, expected value comes into play. And in this regard, for example, let me just give you an idea around this. So let's have the following example. Just imagine you're trading a strategy, and you're about to probably face a trade. Let's say next week. Let's make next week on Monday. You're planning to have a trade, and you're within a competition. Let's say, okay. So you're here in an environment where you compete with others. Let's say a trading contest or something. You may probably have heard about this. And now let's imagine the following: the first 10 people get paid. So if you finish within the first 10, based on whatever criteria, you will get paid, whatever price. And now imagine the following: you're trading an account, and you're working with a preset rules, which means you're risking a certain amount of money, let's say 100 euros, and usually getting paid out, let's say 200 euros, if the market makes it into your take profit. So the payoff, the most you can get out of this trade then means 200 euros. So now let's imagine the following. Let's assume that here the probability really, and now let's make it really easy. Let's say the probability of making it after all the performance you generated over the last weeks within this competition, that you make it within the first 10 is nearly 100%, because market conditions can change and whatever can happen. But still, let's assume that it's 100% that you'll make it, because currently you're placed 6th in this competition. But the thing is, if you now take the trade on Monday and you lose on it, then you're probably not getting paid. By the way, it makes perfect sense, because Monday is the last day of the trading month. It's the end of the quarter, for example. So it also works well from this perspective. So now let's assume the following. The price you're getting paid if you finished within the 10 is minimum 1,000 euros. So the question which arises is, do you keep on trading the strategy, even though the rules tell you to do so. The rules in your trading say consistency in trading is key, and you have to make the trade. But from an expected value perspective, you can say, okay, I'm only going for 200 euros more, while if I lose 100, I will drop out of the first 10 and not make anything at all. So if I don't take the 200 here, I'll get 1,000 minimum. So the expectation here is, or let's say the result, what we will answer to the question, will I take the trade on Monday or not, is I don't take the trade. It doesn't make sense. Sure, you can go for a higher payoff. Then it depends on, let's say, if you make those 200, probably you'll make it, you come in the first 3 or something, and then you get 5,000 euros. Then you have the question, okay, I'm not getting anything at all, but if I'm now risking 100 to make 5,000, probably it makes sense to take the trade nevertheless. But you can see you have to evaluate the certainty of a certain outcome here and use your knowledge around the expected value, in fact. And this is how you can imagine that to some extent, where expected value plays a role not only in your trading, but also in your overall life. Now, it was a trading-related example, but you can probably adopt this to other decisions in your life. So when it comes to profitability in trading, expected value, to know what is expected value is in fact key, because the question, what does it mean I'm profitable in my trading, it's easy to answer, and it's not answered by taking only one trade and then see, let's say you make some money on the trade and say, okay, now I'm profitable in my trading. Everyone knows this, because even if you're, let's say, right 9 out of 10 times, you can still lose money. Let's say every time you make 10 euros, you're right. And then on the 10th trade, you're losing 100, you're stuck 10. So you're at minus 10, which means overall, the approach doesn't seem to be really profitable because the payoff is so unattractive. You can see, okay, now the payoff plays a certain role here in this formula already. And there we have it. So this is the formula around the expected value. And profitability in trading makes perfect sense, because expected value bigger 0. So if this number here, if this formula generates a result which is positive, it means you're profitable. And it's not only related to one trade, but over many trades, in fact. Now, what you can see here is also, it's no coincidence that I underlined average gain and average loss. I already brought it in, even though we haven't defined it yet. So this is obviously the payoff ratio, which already plays a very important role within this formula. And also, it explains why it's so important to let winning trades run and cut losing trades short. Why? Well, letting a winning trade run makes the average gain bigger, while cutting a losing trade short makes the average loss smaller, which means you increase the overall profitability with your trading approach by letting winning trades run and cut them short. So if you hear about this or read about this in a trading book, it's not just a saying from the trader who wants to sound smart or something, but he knows about the formula around the expected value. And this is the reason why you should let winning trades run and cut them short. Now, the thing is, you probably will say, okay, great. Now I have the theory behind this. Okay, let's move on. Let's go to the payoff ratio then. I think it makes more sense to also get an idea of how the expectancy, a negative expectancy, how it's generated in the real world. Look at real trading results from retail traders, because what we already know, and probably some of you may have seen these two graphics already in the last webinar around the trading emotions and behavioral finance. The interesting thing is that we pointed out there that overall the hit rate of many retail traders is quite solid, I think. And this is something you can see here. A quick glance at retail traders. So you have the hit rate here, which is, for example, in Euro USD, over 60%. And just to give you an idea, the next slide will show this. We are looking here at the result of winning and losing trades. 9.4 million trades, I think, were analyzed here within this. So it was Euro USD alone. So there you have gold, there you have the DAX, for example. But the thing is, and this is what is important, obviously, with a hit rate of more than 60% in this context, it should go without a saying, in the normal world, let's say, that those retail traders are profitable, but they are not. So 90-90-90 is true here as well. And the reason for that is because they face loss aversion. And this is also something we know. You can see here that the average gain was, the blue column, only around 20 pips, while the average loss was around 40 pips. And now, if you put in those numbers, the correct numbers here, and we do this in the next slide, within this formula, you will see that obviously retail traders have to be unprofitable, in fact. So, and therefore, we go to the next slide then, and there we have it. So 9.4, that was right, 9.4 million trades were analyzed here within these two graphics. And then we have a look at the winning trades, 5.8 million. So it's more than 50%, 62.3% in fact. So this is our hit rate, while the loss rate here is 37.2. It's 3.5 million trades which were losing trades. And now, usually the question arises, okay, and where's the break-even trades? We don't want to look at them because they're nearly zero. It's 47.765 thousand, or 0.5% of all trades were break-even trades. So trades where you saw the market, let's say, move in your direction and you just trailed the stop to break even. And if we now put in these numbers here within our formula, average gain 121 pips, so nearly 20 as I said, and average loser 41.2 pips. If we put this in within this formula around the expected value, we have the average gain here multiplied with the hit rate. So hit rate 62.3, average gain 21 pips, and then we subtract 41 pips and multiply it with 37.2, you get 13.11 minus 15.33, which means we are losing on average on each trade which is taken. So this is very important to understand. We lose on each trade 2.22 pips, in fact, which is less than zero, which means we are obviously unprofitable. So this is what the last sentence says here. So in our analyzed time frame, the EUR/USD trader lost on average 2.2 pips per trade. Now you might say, okay, well, 2.2, is it really such a big deal? I mean, it's only 2.2 pips. Yes, it is, because we do this on every trade. So it doesn't matter if we are winning or losing. If we win with such an approach here, if we have a winning trade, it means nothing more than we just got lucky. We just woke up on the right side of variance. We are still not profitable. The approach is not profitable. We just got lucky with this trade. And the next thing is something we also have to remember. Usually, retail traders tend to use a very high leverage in their trading. So just to give you an example, over the last days, no joke, I received a mail from someone who asked me, okay, do you think, I mean, what could be the problem? I think I'm probably risking too much. So he's already giving the answer to his question, to his own question. And the question was, if I deposit 1,000 euros and I risk 500 euros per trade and I go all in, is this probably the problem, that I'm risking too much on one trade? I'm not having a stop loss or something. So no joke, that was the question. And it was really difficult for me to answer it, because it's like, what shall I say? Obviously, it's obvious that you're over leveraging your account and you're risking way too much with a too small account. So yes, you should go down, but you obviously don't want to. So probably there's a mental reason to that. Probably he says, hey, this is really, this is great, because the adrenaline now pumping through my veins is bringing me very near, probably into my zone, and I'm now capable of performing really well under other market conditions or in another business, and make more than those 1,000 euros I'm risking here, and where I hope to wake up on the right side of earnings. I really don't know, but the thing is that this is only one example. While it's based on my experience a big problem, usually retail traders tend to leverage their account to an extreme, which makes it very, very likely that even though they're only losing 2.2 pips per trade here, in this example, they're losing the account, and it's only a question when. So this is what the formula also tells us. It's not the question if we lose the account, but if we trade with a negative expectancy in your trading, we will definitely lose. We have no edge. And having no edge means nothing more, the casino, the market wins. Okay, and if the market wins, we are losing, and it only takes time and over a certain period, we will definitely have lost all the money we put in our account. So, so that said, this is what we're here I'm looking at, and what this perfectly illustrates. And yeah, not only what answers the question why you should let winning trades run and cut losing trades short, but also what profitability in fact is in trading. So now the next slide I've prepared is to give you an idea on the so-called payoff ratio and why this is so important. And we already found this payoff ratio within our formula around the expected value. By the way, 1 second, please. I just want to make sure that I see all the questions here. Let me just see. Didn't I open it? I hope just up here. Okay, perfect. So if you have any questions, please feel free to shoot them over here in the chat box. And so now I've underlined average gain and average losing trade. So we already made clear that it's obviously important to let winning trades run, cut losing trades short. Okay, so and there's where the payoff ratio comes into play. And it's not only that this number affects dramatically, let's say, affects the overall expectancy in our trading, but it also increases the chances of staying in the game or going out of the game, going broke. What do I mean by that? Is the payoff ratio is defined as the average gain to the average loss. We already found this, and I can already put it in that way. I can say you should all the time aim for a payoff ratio which is bigger 0, because then you're not dependent on the hit rate. To some extent you are, sure, if you have a payoff ratio, let's say of 1.3, 1.4 to 1, so which means you're making on average 1.3 times more than you're losing on average, then you need to have a hit rate somewhere in the range around 47 to 48%, in fact, to be profitable, to have a positive expectancy. If you only have a hit rate of 40%, then obviously it's not getting the job done. But the approaches, for example, the strategies I've presented on the breakout strategies, on the DAX, on the S&P, they do exactly that. So over the long time, they start to stabilize here around 47 to 48%. And then with a payoff ratio within this range, 1.3, 1.4 to 1, you're making on average per euro risk money, in fact. But now the thing is, so you're looking here for the payoff ratio bigger 1, in fact. But the question is why? Because it decreases the chances of you going broke. So there's this a relation, and the risk of ruin, the number or the parameter we will introduce then in the next slide, obviously decreases with an increasing payoff ratio, which means nothing more, to translate it. If you let winning trades run and cut losing trades short, which means you, by definition, increase the payoff ratio, you decrease the chance of going broke in your trading. Sure, again, it's not very, it's not as simple as that, because you have to look at the hit rate. And again, even if you have on average bigger gain than an average loss, if you do not have the hit rate generating a positive expectancy in your trading, you're still not going to make it. But at the end, here, this is also something which is very, very important from a mental perspective, and which perfectly illustrates that by following the simple rule and trying to overcome this natural loss aversion, which we all have in us due to the fact that we are humans, that then you decrease the chance of going broke with your trading. So the higher the risk of ruin, the higher the chance that you're crushing your account, in fact. And which means nothing more than here, from this fact of following an approach which has this given higher gain, average gain than average loss, it also already results in mental stability due to the fact that I decrease by following these rules here, I decrease the chance of going broke with my trading, which is something which is very important to people. Natural, I mean, that makes sense, right? So if you know that your business, you have only to stay in business, in fact, to see over time your edge to play out and make you money, well, this is way easier than being uncertain all the time and sitting in front of the screen is just thinking, hey, great, I probably see a winning trade today, but I'm not sure whether I'm still in the game tomorrow, or let's say at the end of the week, at the end of the month, whatever. And so by following this approach, let winning trades run and cut losing trades short, increasing the payoff ratio and decreasing the risk of ruin, this naturally results again in mental stability in your trading. And then this is the slide around risk of ruin. So we have to look at this here too. Makes perfect sense because these columns, or not just parameters, let's say parameters within the column risk of money management, risk and money management, they interact with each other. As we have already seen, it makes definitely sense then to look at the risk of ruin here too. So as I already said, the risk of ruin describes the probability of crashing one's account. Or you could also put it a little simpler, and now I introduce something which I call here not the risk of ruin anymore, but the point of ruin. So it's the target, first of all, it's the target of each trader to find an approach that reduces the chances of reaching the point of ruin to 0. But what is this point of ruin probably? You have to introduce this. So let's assume the following. You have a trading strategy which gives you an edge. So you know, based on the backtest you run, that you're trading with an edge. You have a positive expectancy in your trading. And then you say, okay, let's give a number. Let's say 100,000 euros, okay? So this is your trading capital. And then you say, okay, I'm, by the way, only willing to lose 25,000, and then I have to stop here and probably reevaluate whether I'm still willing to put in all the work here in my trading, if it makes sense, if market conditions change so that the strategy is not working, or whatever. And so the 25,000, obviously you're not crashing the account. So if you're paying 100,000 into your account and you're losing only 25,000, then you're still in the game. You still have enough money to trade with. Still, your personal point of ruin then is 25,000 or a max drawdown of 25,000, in fact. Or 25%, which means this is your point of ruin or the risk of ruin of your account. So you're not capable of saying, I risk all those 100,000, I trade till the money is empty and it's no money there anymore. But you say, after 25,000, I make a cut here. And you use this knowledge about your personal risk preferences, let's call it, to then find the right position size thanks to this concept of Monte Carlo simulations, something I will show you within the next slide then. But first of all, let's come back here to the risk of ruin, and a very, I think, very interesting table. In fact, I found in a book, okay, there you can see it already. The personal point of ruin is the point where the trading project ends. So it doesn't necessarily mean to be the point where you lost the complete account, but can be way earlier, in fact. But I want to show you here the following. I think this is a very, very interesting table, in fact. It's from a book, I think it was published at the beginning of the 90s, mid-90s or something. The name of the author, I only know his surname. I think it was Balzara, and he was working on a book on futures and options. And what he did here was he ran several simulations to get an idea on how a hit rate and a payoff ratio play with each other. So you remember I said, even if you have a, let's say, positive payoff ratio or payoff ratio a bigger 1, so you're making on average more than you lose, if the hit rate does not allow the formula around the expected value to become positive, you will still end up crashing your account. It's only a question of time. It's only a question of when, but not if. And so this is how you can understand this table. And it perfectly illustrates, for example, also, by the way, why with a payoff ratio of 1-to-1, for example, a hit rate of 50% is definitely resulting in a crash of your account. You will definitely bust the account or reach the point of ruin, however you put it. So how can this be? Because that does make sense at first glance, right? So if you say a payoff ratio of 1-to-1 and you have hit rate of 50%, then the expected value is 0, right? Exactly. But, and this is the thing, you only need to trade often enough. Rather sooner than later, there will be a streak where you have enough losses generated that you're reaching your point of ruin. So it's bad luck, or on the wrong side, or you wake up on the wrong side of variance, however you put it. So by the way, the payoff ratio already includes commissions. So if you would take out commissions, then it also becomes sensible, right? Because commissions will kill you at the end of the day then. But in this case here, when you include commissions, it means that the waking up on the wrong side of variance will definitely rather sooner or later result in a bust of your account. By the way, you can already see here, if you increase the payoff ratio, if you're capable of increasing it by letting winning trades run, cutting losing trades short, what can you see here in this regard? You can see that you decrease the number to 0. So the risk of re-in then is 0 because or due to the fact, in fact, that the expectancy of your trading becomes positive. So the expected value in your trading then is bigger 0. Yeah, and so that, well, with that in mind, in fact, we can perfectly understand why it obviously makes sense to let winning trades run, cut losing trades short, in fact. And probably we should leave it with that. Then, in fact, I think this is already I'm giving a good idea. I think what's probably way more interesting is now to get an idea on those Monte Carlo simulations. So for that purpose of the right position size, probably remember last week when we talked about the right position size, we used this Kelly criterion. And Kelly didn't really look at drawdowns, and we had to make adaptations here to the formula. Still, the risk of re-in, the risk of reaching our point of re-in or crushing the account was 0, since it was dependent on the hit rate, which means if you have a losing trade, naturally the hit rate will decrease, which will naturally result in a reduction of the position size based on Kelly, in fact. But still, while we didn't really focus on drawdowns here, what we will now do probably gets exactly this job done. So, in fact, for the purpose of finding our right position size, we will use so-called Monte Carlo simulations, and here the so-called Bernoulli distribution. I don't want to dig into too much details here, so giving no explanation now what is a Bernoulli distribution. In fact, it's very easy to understand. You just give a winning trade a 1, and you have a losing trade, you give him a 0, and then you simulate certain rows of results here, in fact. Nothing more, nothing less, in fact. And you have only these 2 results. It's a winning trade or it's a losing trade. Nothing in between. So this is in a very easy, rough way explained what the Bernoulli distribution is, in fact. And now what we want to do is we want to use the trading strategy I'm shown you here in regards to the DAX. And probably some of you remember the numbers. If not, no problem, because it's very easy to remember. The hit rate here for the backtest was 42%, while the payoff ratio was 1.5 to 1, in fact. And then we looked at 500, we want to use 500 trades, simulated. And now there's a small problem with that. I had this problem already last week. The problem is that this simulator is a German simulator. It's from my website. I wrote a book in German, and I will also present you the URL below this video here, in fact. So you can click there and play with it a little. I think it's self-explaining. Still, here today, we only want to look at the result and how to find the right position size thanks to those parameters and how to use risk and money management then in the real trading world. So what do we have here is, in fact, different equity curves, simulated equity curves, given or resulting out of those given input parameters. So the hit rate of 42% here and the payoff ratio here of 1.5 to 8. So it has a positive expectancy. So all in all, we also know that the risk of re-in here of this approach, if we can stabilize those 2 parameters, is 0. There you can see the Erwartungswert. This is the German word for expected value. 1 second, please. And as long as this number is positive, we have a risk of ruin of 0. Still, and now the max drawdown comes into play. Still, you can see here that within this, so we risk here 1% per trade of our trading equity. The max drawdown here was 21.5, which is already elevated, let's say, and I only need to generate enough simulations here, and I will easily push this number way above 30%. So put it differently, take our example of 100,000 where we risk 25% or 25,000. It's an adequate position size. We need to decrease the position size here to 0.5, probably, yeah, 0.8. I probably should have started with 0.8 and then probably go down to 0.5%. This will naturally result in a decrease of your average performance here. which will naturally decrease. Still, we will also see that the max drawdown then comes within our risk preference, and we probably have to trade a very long time span to reach our personal point of ruin. And this is also something you should remember here, and this is where we want to stop then also on this topic, because we probably dig too deep into this matter. Again, around 2-3 weeks, something in October, we will have this as in a separate webinar and talk about it in depth, in fact. But very important is, you're looking at static numbers here, so which means they do not move, they are not dynamic, it's they are fixed. And then you think that you will stabilize at 42%, and you also stabilize with a payoff ratio of 1.58 to 1, which is not true, because you learn over time, you learn, you evolve, and which means nothing more than you will probably formulate a strategy to try to make losing trades, cut them shorter than they should be, for example. There's a technique we call scale out, for example. So scale out of losing positions. There's certain techniques. You can use price action as an indicator when to reduce the position size. You can also use, for example, time scale outs. So you could say, I know, thanks to my detailed trading, and I will show you how to do that, in fact, very effectively, in my opinion. You can, for example, say, hey, I have an average trade duration of, let's say, 2 hours. And if the market did not move in my direction, let's say 1 hour minimum after 1 hour, I will take out half of the position here. For example, these are very effective scale-out techniques, and they all aim to get one thing done: reduce potential drawdowns here, reduce the average loss, respectively try to increase the payoff ratio, which overall reduces your chances of reaching your personal point of ruin. So you can see how these components play with each other. So let's have a look here at the summary. So risk and money management is one of the 3 columns of profitable trading. We know this now. And some of the key parameters here within this column of risk and money management are the expected value, the payoff ratio, and the risk of ruin. I hope that you have seen how these play with each other. And if you now put in all the work around your personal risk profile, you will probably find a very effective and easy way to define the optimal position size for a given trading strategy. For example, by using Monte Carlo simulations within your trading. And what will happen is naturally the following: it will add significantly to your overall mental stability in your trading. Because if you know what to expect, expected value, no coincidence, then you will probably overcome certain feelings easier, like loss aversion, for example, if you really know how it negatively affects your trading, and that it is no real good idea to cut winning trades short while letting losing trades run, for example. It adds significantly to your overall mental stability and will naturally result in you becoming less stressed and more relaxed, calmer in your overall trading every day. Yeah, and so in fact, that's it around this topic. I want to, and now I have to switch through this here a little quicker. So we had an idea after the first trading spotlight webinars were such a great success for us, and the feedback was just really nice. We thought, okay, how can we probably give even more information away and probably add even more value? And the idea was simple, in fact, and easily created. So we created on tradersyard.com, we created a community. You can see it here. It's a Trading Spotlight trading group, in fact. And I've prepared this already here. 1 second, where do you have it? Here, there you can see it. So this is the Trading Spotlight community. Just check out the chat box here below, or below the recording of the YouTube video, or probably just type in tradersyard.com right now in your browser. You can join. It's completely for free. So at least now for 1 month. So we decided to give it a try for 1 month, and all who register now won't easily register in 1 month from now, because from 1 month from now, we thought that's probably making sense to give access here only to live clients from Admiral Market. So feel free to join now. It makes definitely sense. And so to give you an idea what happens here, I probably use my tweets from today. So it's not only the promotion of today's trading spotlight, but also here, I'm tweeting around the trades I make within the DAX trading strategy, open range strategy, and also the S&P strategy. And I track those results here on FX Blue. These are the results. I mean, it's ridiculous. Let's say it's 7 days only. Let's hope that this continues, but I doubt it. It will probably drift into the right direction, very likely, since I have a positive expectancy with my trading here. Still, these first results of the week were really, really good. So we had 4 trades so far, 3 winners, while where 2 hit the take profit level and paid out very nicely, and we only faced 1 loss. Yesterday we got a little unlucky, so the trade would have triggered the take profit level, while wasn't really filled because we worked with a limit order. We had to work with a limit order. Why? You can all find these informations here within this community. And now the idea behind this is not only to brag with winning trades or something. No, the complete opposite is true. We want to really show how professional traders think, how they track their trading, and how they work with these numbers. So all these numbers I presented to you now, they are fine. It's good to know the theory behind this. Still, to have real trading results and then work with these numbers. For example, average gain to average loss, for example, here, and the hit rate. You can work with all this knowledge we presented here within the last minutes in a real environment and with real numbers, and get an idea of, for example, the risk of ruin in your trading and all this. It's very, very important to really also use this knowledge then and see how it works in practice, and how to use it in the real world. And this is in fact the idea behind this spotlight trading group. So feel free to join now, to join today. And also don't forget to join us next time. So Monday, 2 p.m. London, Paul will be here on showing you how to use the commitment of traders report in your trading. What is the CUT? Why is it useful for traders? In fact, just to give you an idea, Larry Williams, one of the greatest traders of our time, once said this is probably the most valuable information which is out there for traders. If it's retail or professionals, it doesn't really matter. And not only that, but it's for free. So it's published every Friday. It's for free, completely free. You can see what the big guys with big money do, and you don't even have to pay for that. And that's why Larry Williams called it one of the most valuable sources in everyone's trading, in fact. And yeah, how does it influence the markets? Which instruments are effective, and how can you use it in your trading? These are the questions which will be answered by Paul. 2 p.m. I think it's 2 p.m. London. I'm not sure, but I think it's a British summertime. But I don't really know. To be honest, I don't really. So it's definitely 3 p.m. Central European summertime. That's what I can say. And yeah, the link for the webinar will be sent to your inbox here. You can also register on the website from Admiral Markets. And admiralmarkets.com is the website to go, the URL. You have to go here. Here are the contact details. And very important at the end, the risk disclaimer. And that's it from my end. So I hope you enjoyed this, enjoyed the webinar today. I wish you a very nice weekend. Enjoy yourself. Talk to you again then next week on Friday, Trading Spotlight. Again, with me, respectively, join already Paul and Marcus on Monday, respectively Wednesday. That's it from my end. So have a nice one. Talk to you. See you, and bye-bye.